Hi, everyone. And once again, an official welcome to the Professional Investor Business Plan live series, part 2. Last week, part 1, we talked about some very interesting and very important ideas or concepts that will lay the foundation of your business plan. And so we covered some key questions that we needed to ask, and we needed to answer, at least conceptually speaking. Two of them were, what does it take to be a good trader? And what does a good trade consist of, generally speaking? This is something that all of you should know by heart by now. And so a good trader, in my humble opinion, is a good decision maker. They make future predictions based on a study of the past. They understand the fundamental drivers of the markets they trade them. And above all, they are good money managers. So each and every trade that we will take conceptually will consist of two elements: the fundamental condition of the market and a way of timing the market with a good risk to reward proposition. And we have separate strategies, indicators, as well as technical strategies to do that. And with all of that, what we're trying to do is we're trying to align ourselves, our investment, with the billion-dollar institutional powerhouses of the market, and we want to follow them. Our expectation in the market is that the market is imperfect. So that is important for us to understand, because we cannot be a perfect player in this game, right? We can be consistent, we can become consistent at this game. And what we're going to do today, while I speak about consistency, is we're going to speak about money management and what that entails. Money management, I believe, is the kingdom to wealth. And consistency in trading may mean something completely different to what you may think of being consistent in other aspects of your life. And we're going to talk about it. We're going to take a different angle on that, a neuroscience angle. So you guys know I'm not a neuroscientist, but there are very, very interesting and informative papers out there, dated papers, so very recent papers that we can teach, we can actually learn a lot from by just understanding the mechanics and things that are happening within our brains when we learn. But before we do all of that, let's talk again about our KPIs, just really quickly, because this is where we left off last time. And so what we talked about is that we're going to try and achieve an average of 2 hours per month. That is our conservative goal in the beginning. And that can even be your goal for the rest of your life. And to achieve an average of 2 hours per month, you will need 2 KPIs. And those 2 KPIs you need to not just understand, but you also need to obviously understand the calculations behind it, but also which one of the 2 is potentially more important. So we're going to do also some examples here as well. We have an average risk to reward ratio of 1:2. And we have an average win to loss ratio of 40/60. And as we have a multiple of trades, we then can look at how many trades were winners, how many trades were losers. And out of our winners, what was our average risk to reward ratio? In other words, the winners that I had, how profitable were they? And as we then apply our risk size calculation, our risk size parameters in line with our account size, we will then basically get a risk per trade. We will get a loss or a reward at the end of the day, at the end of each trade. And after 10 trades, we'll have a monetary outcome, but more importantly as well, we'll have a KPI outcome. Now, I'm more interested in the KPI outcome, and so should you, because the KPIs are going to be measured objectively and the same way every single time. And before I even go into the rest of our money management topics, like what are some chances for us to over leverage in the market? When can we risk more? What are some risk limitations to avoid large drawdowns? How about chasing price? What are some of our golden rules on risk management? Before we talk about all of that, I actually want to quickly talk about milestone planning and just seed some information here, because this is going to be important for you to really understand the money management topic as well. So I'm going to be jumping forth and back a little bit today. Overall, though, for the next hour or so, we will spend the entire time on milestone planning and money management. So let's talk about milestone planning for a second. This is a table that should not just be included conceptually as part of your business plan, as part of your trade plans, but it also should be included in your trading logs. And trading logs is a topic we skipped last time. We also skipped today. Trading log is something that we will cover only later down the road. And as I already teased during part 1, we were actually going to look at Tanu's trade log, because he's created a very professional and dynamic trade log that you guys can leverage on and build on to create your own trade logs. And so we're going to do that as well. And it's really going to get juicy and interesting and interactive. But at first, of course, we need to lay the groundwork for all of that. So as you can see, the table right here includes at the very left column the level, and that is the milestone level. So we will start at 1, and this could be 0. And then there's going to be 2, 3, 4, 5, 6, 7. So as we talk about milestones, of course, we have to talk about the setting, the assessing, and the pursuing of our goals, of our targets, of our KPIs, right? And so this has to be also objectively planned, beforehand, before you even think about scaling up your business. You should think about, first of all, what is a potential risk parameter that you're willing to risk in the beginning of your trading career. If you're not in the beginning of your trading career, you may be down the road here somewhere. That is fine. But if you're in the beginning, then you may be thinking, well, I start at 1 or I start at 0. If you start at 1, then you potentially are going to risk $200 per trade. And so if you're going to risk $200 per trade, again, you go back to the risk size calculation, you should have at least $2,000 in your account. And so 10% of that would be $200. That 10% is the risk parameter for a beginner. If you're a well-seasoned trader, then you can go as high as 20%, assuming that the money that you see here is not all the liquidity that you have in the world. And so you may start with $200 right here, and then you're going to trade, and eventually you can track your risk to reward, and you can track your average win to loss. And at the end of the day, if you go with our conservative targets here of, let's say, after 10 trades, achieving a 1 to 2 and then a 40-60 in terms of win to loss, then you actually walk out with a 2R cumulative at the end of the month, which then should put you at $400, assuming 10 trades in a month at the end of the month. And so that would be a yearly profit of $4,800. You can start at level 1. Level 1 could also be $100. It could also be $50. It could also be $500. That is going to be subjective and relative. For me, I always say this needs to be a number that is relatively low in a sense that it doesn't make a difference to your life. Even if you lose 10 trades in a row, it should not mean that you are going to potentially risk the lifestyle that you're living at the moment by risking too much money, right? Because in the beginning, it's all about the learning effect. It's not so much about making money. That comes later once you become more consistent. Let's say you do that for 10 trades and your objective KPIs were positive. What you're going to do, you're going to go to the next milestone, $400, right? You're just going to do exactly the same things, look for the same trades. And as you achieve the same KPIs, at the end, you walk out with $800 per month, and then you walk out with $9,000 roughly at the end of the year. And then it continues on and on and on, right? And so what this also helps you is the understanding of what are my capital requirements in terms of my maybe intermediate or ultimate income goal, right? So let's say you want to achieve $5,000 of monthly income. Then you need to be at milestone 5 eventually, because milestone 5 is with a risk size of $2,000 is going to give you roughly $4,000 per month. And so $50,000 roughly at the end of the year. And so if this is an intermediate target of yours, then you already understand, I need to be able to risk $2,000 per month. What does that mean in terms of account size requirements? Well, that means I need to have a $20,000 account in order to do that. And so you get a general idea of what you need and how do you get there, and when potentially can you get there, depending on your trade performance. Now, Siwar has a question. Let me just read that out. After how many successful months do you move from level 1 to level 2? Right, we're going to talk about that now. Right, so just one more topic here, and then we move on. So a lot of people ask me, Jan, what should I do? Where should I start? And we touched on that a little bit. If you feel uncomfortable risking money, right, even if that's a low amount of money, then it's also okay to start at level 0. Level 0 would mean starting with a demo account. A lot of people smile when they hear, haha, they trade with demo. That's not the real world. Yes, while this is true, I personally think that's completely fine. And if you come to think about it, what is a demo account? Well, a demo account allows you to make a lot more mistakes without losing potentially confidence in the game. And if you think about other professions, for example, let's say a heart surgeon, right? I'm not saying we're heart surgeons here, but also heart surgeons, they don't go and operate on real people right away, right? They, of course, use something similar to a demo account in order to practice and in order to excel in their profession, to get better, right? Because as the heart surgeon uses their way of a demo account, they can make mistakes all they want. It doesn't matter. And they can get a better understanding of what really works and what doesn't, right? He may be shaking in the beginning. And so what can he do to get rid of that shaking emotion? And then at some point, he can move on. He can move out of the demo. They can move out of the demo. And that is very similar to trading, I think. So I think it's completely fine to use the demo in the beginning, for sure. However, as you use the demo, don't use it for too long, because you do want to get your emotions involved in the game as well. And you do want to learn how you react to certain situations as well. So in the demo, I would say spend a maximum of 5 to 10 trades in the demo and then move on. Whether they are profitable or non-profitable at the end of the day, you shouldn't spend too much time in the demo. You want to get in the real, you want to get into the habit of trading real money, right? And so that is why we use CFDs, and trading CFDs just allows us to be a lot more flexible in terms of our risk and capital requirements as we get a lot more leverage. And so we can be flexible in terms of how much we're willing to risk. Now, when it comes to scaling up the business, I think this should be done with a formula that you should follow. That goes back to Siwa's question. Of course, it's important to scale up the business. When you do well, you scale it up, but also when you don't do well, you will scale down as well. And that's going to be more important as you move up in terms of risk size and milestone and actually the monetary game that's behind it. So what you are going to do is you're going to review your trade performance based on your objective measurable KPIs after every 10 trades. That's it. I don't want you to wait too long before you move up the milestone. You can always move back down, but I want you to be rather quick at that, right? And so when I also say from 1,000 to 2,000, you can have a step in between here as well. But I want you to be rather quick with moving up the milestone levels here. So on average, 10 trades. In the beginning, use less trades, right? Try to really achieve a milestone, a higher milestone from the beginning rather fast. And then as you are down here later on, you can spend some more time on these. But on average, maybe every 10 trades. So the formula looks like the following. If I achieve my conservative targets after 10 trades, then you will move to the next milestone. Simple. If you will break even or slightly in the loss, then you will stay in the same milestone for 5 more trades and then reevaluate based on the 10 most recent trades. So you will always take the 10 most recent trades and you will evaluate after taking 10 new trades. If you're just slightly in the loss, no problem. But if you have large drawdowns, right? If you have large drawdowns, if you are within a losing streak at the moment, then you will decrease your risk size and move to the previous milestone for 5 trades and then reevaluate based on the 10 most recent trades. Okay, and this is also important. I'll explain later on why the scaling down of your business may be important at times. So how does that then look like in the real world? And in the real world, this then looks like this, for example. You have 10 trades here. And as part of your log, you're going to have your milestone levels here, 1 and 2. And so let's just say these are your first 10 trades, and then these are your second 10, your second batch of 10 trades. In the beginning, you're going to risk $200 per trade. You're going to take 10 trades. Let's say the first one is going to be a winner. The second one is going to be the first one is going to be a winner. The second one is going to be a loser. Then you're going to lose again. You're going to lose again 3 times in a row. You're going to have a break-even trade. Then you have another break-even trade. Then you may have 2 winners in a row. And then you again end your 10 trades with 2 more losers. What is that going to mean in terms of risk reward? Well, let's just talk about some hypothetical examples, and let's also all keep in mind they're hypothetical. I'm trying to keep it real here, right? So I'm not going to go astronomical, but of course we're going to look at some variations and alternatives here as well, as you have to understand how these numbers flow into your averages up here and what that means in terms of the end monetary goal. We can start with the losers. The losers are simple, right? And so as we're within one milestone, we're always going to try and risk the same amount. We're not going to risk a lot more. We're not going to risk a lot less, unless there are certain examples that we're going to speak about where we can risk more. But on average, we should always risk the same amount. What does that look like? Well, that should look the same, right? This should be the same ballpark number on all of our losses. What shouldn't happen is that we have a -2 and a -3 here, because that will, later on I'll show you, completely mess up your entire, your entire calculation and your entire averages. So we need to be consistent within our milestones. Let's just say the first winner, we achieved the 1 to 2, right? Then on the second winner, let's say we achieved a 1 to 4. And on the last winner, we just had a 1, for example, right? And our break-even trades, of course, they were a zero-sum game. What is going to happen here is that we're going to walk out with $400 at the end of 10 trades. And so those would be 2 hours, right? This would be 2 hours. What we have to ask though, this is not so important for me. What's important for me are your average KPIs. And your average KPIs, let's start with the win to loss ratio, because this is a little simpler. When we take the win to loss ratio, we're only going to take the winners and we're only going to take the losers. So we have 3 winners, right? 1, 2, 3. And we have 1, 2, 3, 4, 5 losers. So it's going to be 3 divided by 5. And so we actually have a 40-60 here, right? So a 60%, sorry, that's wrong. Winners, we have 1, 2, 3, and losers, we have 1, 2, 3, 4, 5, but we have 8 trades in total, 8 winners and losers, but 3 winners. So it's actually 3 divided by 8. So you have 3 divided by 8. And so we have a 38% winning ratio, 38% hit rate. So that means if 38% of all of our trades are winners, the rest are going to be our losers. So we have a 38 to 62 is going to be our ratio, right? So 38 to 62. That's our win to loss ratio. Close to a 40-60, right? Very close to a 40-60 here. Our average risk to reward, here we're only going to look at our winners. And so we have a 2, we have a 4, and we have a 1. So 2 plus 4 plus 1 equals 7. So we have 7 hours in total out of 3 trades. And so on average, 7 divided by 3, on average, we make it, our profitability is, we make just over 2 hours, just over $2 for every dollar that we risk. And so if we risk $100 on every trade, we make $233 on average. So that is our average profitability per trade, our average risk to reward ratio. It only takes all the winners into account. So in this case, we would have a 1, 2, 2.3, right? And you can see these targets here, right? I purposely chose this to show you that these targets, very conservative targets, you walk out to be profitable at the end of the day. Doesn't matter how profitable you are, right? And what the number is here, it could be more. What it shouldn't be less. If it's less, you stay in the same milestone. But now let's say we achieved this, right? We achieved this. This could have been achieved in many different ways, by the way, as well, right? And so this is definitely mission accomplished. But let's talk about, for example, on one trade, on one of the losers, I was a bit greedy and I thought, oh, things are going so well. I had 2 winners in a row. Now I have a lot of money in my account and I'm going to risk more. I'm going to risk 3 times the amount. What is going to happen as you now risk 3 times the amount? If this is the one that's a loser, it's going to push you back in terms of your monetary outcome. However, your KPIs will stay the same. So even though your KPIs may be profitable on the paper, your total profit at the end of the day, monetary speaking, is going to be a loss. So we need to speak about, of course, us also playing the game right? Playing the game right. What could also happen, we could also have, let's say, for example, one of those break-even trades being a loser, right? You can see, even if one of them, even if both of them are losers, it would still be a zero-sum game. And so in this case, we lost 1, 2, 3, 4, 5, 6, 7 trades. We won 3 trades out of 10 trades. And so in this case, we would have a 30-70 win to loss ratio. And with a 30-70 here and the same average risk to reward, you can see that we're not making any money. But what if our average risk to reward was to be a little better? Instead of this being a 1-to-1, we make a 1-to-2 here. Now, all of a sudden, we're back at making money, right? We're back at making money. And we're actually, our average risk to reward is not a lot higher than before. It's 1 to 2.3 before. Now it's going to be 2 plus 4 plus 2 is 8 divided by 3. 8 divided by 3, 2.6 average profitability in terms of 2.3. Now we're in the money, right? Now we're in the money. If our average risk to reward is higher, of course, we make more money. And so the rule of thumb is, and what you can also see, if we are very profitable per trade, right? Let's make this extreme. We have 2 1-to-4s, right? We have 2 1-to-4s, and everything else is a loser. So actually, we're only right 2 times out of 10 times, but we made a 1-to-4 on all of those trades. So our average risk to reward would be a 1-to-4. You can see that we're not in the money, but we're also not in the loss. So clearly, this is the leverage that we have, right? This is what we have to lever in our favor and maximize, because we know we can't get much better than a 40-60, right? We can get much better than a 40-60 or a 50-50, or sometimes even a 60-40, depending on the time. But we can get much better than this. Why can't there be 80? Why can't this be 80-20? Why is this a percent? Anyways. $80-20. Why can't this be an 80-20? This can't be an 80-20 because if we had an 80% success rate, if we achieved that, then we would be as good as JP Morgan Chase trading desk, right? So I would say that I'm on par doing this consistently. I would say my knowledge and my skill set is on par with the best trading desk on this planet. The best staff, the best team of analysts, having the best researchers, and having access to information way before anyone else has access to it, and also different information. I cannot say that, right? I don't sit with JP Morgan Chase, and I don't sit at their trading desk. I sit here in Dubai in my trading office. And so I'm not as good as them, and I don't need to be. All I need to achieve is roughly every second trade needs to be a winner. And as I achieved this, you did see that we were profitable, right? Even if we have a 2080, technically speaking, we could be profitable. But then our average risk to reward needs to be extremely high, right? To achieve 2 hours at the end of the month, we would have to have an average risk to reward of 1 to 5 per trade, right? And so that is extremely high, but it's also possible. So you can see there's also not just one outcome. These win to loss ratios, as well as your average risk to reward ratios, they may change depending on your trade log and your trade performance. And you may set yourself different targets, right? Because this could look very differently depending on the situation that you are in at the moment. What I'm saying though is that the most conservative thing that we can plan for is also to have a solid win to loss ratio, because with a solid win to loss ratio, you will also gain a lot more confidence. It's very hard to be wrong more times than you're right. And I'll also speak about why this is the case. Colin is asking a question here. Isn't that sooner or later? So I'm going to read out what he says. Isn't that sooner or later we may end up with trades with different risks, as the 10 trades with lower risk are not supposed to exit all in the same time? How to be dealing with such a situation and transition, right? It may be possible that you have running trades, and as you have exited some of your running trades, it may be the case that 10 of your most recent trades in terms of KPIs are solid, and then you move on to the next milestone. And then it's just what it is. Then you have one trade still running on the old milestone, and then all the new trades will be running on the new milestone. However, Colin, what you have to understand is that we're not counting running trades in our trade log, right? We will only count them, and they will only flow into our averages as we exited a trade. Because a 1 to 4 today could be a 1 to 3 tomorrow. It could also be a 1 to 8 the next day. And so we never quite are sure where we may be exiting that trade. And so as we're measuring our performance, we can only measure it objectively as we take only the trades into consideration. Very good question. That we have exited. And if you do that, you will not run into a situation, very rarely, where you may still have running trades on the old milestone level, and then you have new ones, and you have this kind of overlap. It may happen, but if that also happens, it's a luxury problem, because it means you're doing extremely well and you're holding on to trades for longer too. Does that make sense? Right. So all of these trades are exited. They're done, right? No running trades. And so this could be a profitable scenario, though what we like to have here, of course, is just a 40-60. So we're not even right every second time. And we have a 1 to 2 on average here. And we walk out with $400. And you can achieve that as you've seen before. Now, what's going to happen? You have a green check mark. You have a green check mark. And you're in a situation where CWAR is at the moment. And this is a situation to celebrate, right? And to really reward yourself. How are you going to reward yourself? You're going to give yourself a salary rise. Now, what is a salary rise for us? A salary rise does not mean we're going to trade more, we're going to trade differently, we're going to invent the wheel. It simply means we move on to our next milestone. Now, what's our next agreed upon milestone? Our next agreed upon milestone is $400. So now we're going to say, all right, I'm going to trade with the same set of rules. I may have tweaked them in the process a little bit, slightly, depending on my trade log, right? Depending on what works best for you personally. And then you move on to the next level, to the next trade log, to the next trades, to the next milestones. $400, and now you do again 10 trades, right? And so, for example, once again, we win. And let's say we have a very bad losing streak, a very, very bad losing streak here, right? Very, very bad losing streak. 1, 2, 3, 4, 5, 6, 7 trades in a row we lost. The first trade was a winner. We made it 2. And now we lost all these trades, right? And on paper, we're like, damn, what the heck is going on? And so if you find yourself showing a losing streak at the moment, right after you scaled up your business, that potentially means you may want to scale back down, right? You may want to scale back down. Though really wait 10 trades, right? You really want to wait 10 trades on average, because the next 2 may be the winners, right? And so as the next 2 are the winners, and on those 2, you achieve maybe also a 2, 1 to 2 and a 1 to 2, you only are down by $400. And so if you're down by $400 at the end of the month, that is fine. You don't have to scale down your business. But if you're down a multiple of what your R is, right? And so if those 2 were break-even trades, then you're down a multiple of your R. It's obviously not working for you at the moment. So you again need to go through the process, gaining confidence. What did I do wrong? What did I do right here? What did I do wrong potentially here? You may have not even done anything wrong. Those are also sometimes the case, but talk about all scenarios here. So usually the rule of thumb is, in the beginning, as you scale up the business, if you have a multiple of R's in the loss, you want to scale down your business, right? And so let's though talk about a scenario where you're potentially in the profit. So you have 1 break-even trade and you have 2 more winners. One made a 4 and the other made a 3, right? This is a loss, so it's a -1. So now you can see you've had 3 winners again. 3 winners out of 1, 2, 3. Out of 9 trades, we only count 9 trades because 1 is break even. We don't count that at all. And so 3 winners out of 9 trades. Our win to loss now is 3 divided by 9 is 33%. So it's a lot less than our win to loss ratio before. So it seems like at first glance, it seems like, oh, we're doing a lot worse, right? It seems like we're doing a lot worse. But as we are, so 33, the 67, as we may be doing a lot worse here, we have to look at what was the average risk to reward. And so the average risk to reward, we had one with a 2, one we exited with a 4, and one we exited with a 3. So my average risk to reward is 9 divided by 3. 9 divided by 3. And so I actually make $3 for every dollar I risk. 1, 2, 3. And so we can see this is now a 3 hours, right, at the end of 10 trades. Even though our hit rate, our winning ratio is less than before, we were right less times, we actually were more profitable. And in terms of, we didn't achieve 2 hours, we achieved 3 hours. Why is that? That is because we were more profitable per trade, per winner. And that is very important as we move on. We really want to deal with our trade log in a way. We want to build up a trade log in a way where we can leverage on that, not just tracking what is our average risk to reward and win to loss, what trade was a loser, what trade was a winner, but really understanding and analyzing which one were the winners, which one were the big gainers, and why were they big gainers. So you can eventually start maximizing and leveraging on the things that you do extremely well, becoming more efficient as a trader and as an investor. And the beautiful thing is, as you move down the milestones and the more experience you gain, naturally, the better you will become here, because you also have a better understanding of what works and what doesn't work for you. And so that is very, very beautiful. Now, what also may be happening is that you may over leverage on a trade. We talk about this in a second. And so, for example, you may over leverage on a trade. You do this consistently, right? So let's say you over leveraged on this one. This is a -2. And you leveraged on this one. So this would become a +4. It would double, right? And so as you do this consistently on the right trades, your monetary outcome, even though your risk to reward, your win to loss will not change, your monetary outcome may increase significantly. Now, I don't care about your monetary end goal, right? And I don't care what stands there. As long as your KPIs are sound, there should be a positive number in the back. What I don't want to see is a positive number in the back because you over leveraged on that one trade that did extremely well, right? But all the other trades were bad, were losers, right? And so you may have over leveraged on that one trade. You may have risked more on that one trade. And all of a sudden, you are in the profit at the end of the day. I'm walking out with 3 hours. Ha, ha, ha. I'm so good. No, you just got lucky as your over leveraged trade worked and all the others didn't. And so you really need to be cautious in terms of tracking your KPIs and not the monetary amount here at the end. And as you achieve that eventually, right? As you achieve that, then again, you're going to move to milestone 3. What is going to happen as you move to milestone 3? Well, let's check milestone 3. I agreed to risk $700. Now you're going to risk $700 per trade. You do everything the same. And this is how you end up making more money at the end of 10 trades. And this is how you end up eventually achieving your income goals. So CR is asking a question: do you over leverage when you have an all stars aligned scenario? Yes, we talk about the over leverage scenario as well. It's very important in my opinion to be doing that in the beginning, especially sometimes to over leverage yourself. And what does it really mean to over leverage yourself? We need to speak about this as well. But before that, I really want everyone to give me kind of a check that they have understand the mechanics of the milestones and how our KPIs will flow into those milestones. Very clear, understood. Okay. And I may be running just a little longer today because we need to cover a few things that just, I don't want there to be too much time in between lessons. And so this is clear for everyone, great. And so out of interest, if someone wants to share, what's your average risk to reward and your average win to loss at the moment for the past two or 3 months? If someone wants to share, you can do that. Maybe give us all some hope and motivation in the game. Until you do, let me just move on here. The question now becomes, and something that obviously I struggle with to understand is, if those targets are so conservative, then why is it that not everyone is meeting those goals right away? And there's an answer to that as well. At least I found an answer. And I'm going to try to explain that to you with what I think is the bell curve of our trading performance. And so what you can see right here is the bell curve of our trading performance. And this is where we want to be, our average performance, right? So statistically speaking, this is where the highest chunk of trades should be, right within that. Losing one, winning one, always having a 1 to 2, a 1 to 2, a 1 to 2, losing one, winning one, losing one, winning one, not having streaks. And so what happens though, unfortunately, is that the real world of trading, at least from what I've experienced in the past close to 10 years of trading, and I've also not seen it any other way, are winning streaks and losing streaks. So even though this is where we want to be, where we actually operate is on this extreme, on the winning streak side, where we have a lot of winners in a row, and on the losing side, where we may experience a lot of losing trades in a row. And so what happens mentally, and what I see a lot of people doing that mistake, is on and off and on and off in terms of how active they are as traders in the marketplace. And so what usually happens is, as we have a winning streak, people become more interested. People see, oh, there's things happening on the news feed. People are making money. People are hyping stuff on social media. Everyone is happy. People are making money. What is happening? More people become more active again in trading and investing. And what the problem with that is, that they may be becoming active in the middle, or worst case scenario, towards the end of a winning streak. And what you're getting as you get interested and as you get active again is you catch losing trades. And this doesn't really have to be a losing streak. This can just be a couple of losers in a row. And instantly what's going to happen is you may lose interest. You're like, oh, damn, again, I trade. And when I trade, I lose. It's just not meant to be for me. It's just, I'm just not lucky in this game. And so you're again off until you see that things are going well, and then you miss the winning streak. Worst case scenario is you miss the winning streak, and or during the winning streak, because you entered late, you may even do mistakes because you were not ready for it. You may even lose money here, and then you lose money here again. Then definitely you're going to be out of the game because you're like, damn, this is not for me. this is too difficult. All right, and you're going to say, this is too difficult. And that is something that I really have an issue with, is that phrase, that is too difficult. And what I also have an issue with, and I see that extremely often, is high intensity from people that are inconsistent, right? And so usually high intensity comes with inconsistency. This is just when we talked about our daily routine and how the routine is important, right? Make yourself a schedule that's realistic to achieve. We don't want to fall off that cliff, right? And so as we don't want to fall off that cliff, we also want to be consistent, but with only very little intensity. We should always be doing the same kind of hours, right? And as that circle goes, you may be saying, this is just too difficult. I just can't do it. It's not happening for me. What you need to be visualizing is that the entire game, the imperfect game of trading, consists of winning streaks and losing streaks. And our parameters in terms of KPIs are different to anything else that you have ever experienced in all of your life, regardless of whether that may be school, education, or whether that may be the corporate job, your corporate job. Imagine you go to your manager or to your director or to whoever you report and you say, 50% of work I've done, 50% of work I haven't done. Sorry, I just couldn't do it. Or back at school, you only, in the tests that you took, only 40% of your test was correct, 60% was incorrect. You would fail every single course. So we have been trained a certain way. We have been trained to be accurate most of the time in order to be successful in life. And what I really found is that there's a reason for that as well. And so when you find yourself losing interest, when you have a losing streak, or when you have a couple of losers, oftentimes I hear, I lost 3 trades in a row, 2 trades in a row, and I am just so frustrated and I just can't take it anymore. It's too difficult. I can't do it. Now, what you need to understand is that this is absolutely normal, that we are psychologically, not just psychologically, but neuroscientifically wired that way, right? And so neuroscience, there's actually now a lot of new papers that are coming up that talk about the setting, assessing, and the pursuing of goals. And I just want to talk a little bit about a very interesting paper that I read. So also, I'm not a neuroscientist, right? So take this information with a grain of salt, but obviously what I'm telling you is not what I think, it's what, what's in this paper. And what you will find is that there is actually a reason to why you behave and why you think a certain way. So it helps, in my opinion, to understand the mechanics of why you may feel a certain way in a certain situation, and that is normal, and that you're not the only person in the room who may feel that way, right? And what needs to happen though for us is we need to rewire that. We need to change our KPI setting and the way how we approach and think and even talk about losing trades. And so first of all, when we of course talk about learning, right? And when we speak about learning, there's a specific word in the neuroscience world. They call it neuroplasticity. And that's just the ability for your brain to change in response to experience. And so that's just the process that happens when we learn. All that is that reorganization of connections in our nervous system, in our brain. And so that comes with that notion, and the only way how this can be achieved, the only way how your connections in your nervous system can reorganize is if you make errors, right? Because with errors, you actually, with every error you take, these connections, they are reorganizing. And there's actually also a process that goes on in the brain that makes us more alert when that kind of stuff happens, so that on the next attempt that we try to learn the same subject, trading, for example, we have a heightened level of focus and a higher probability as a result of then learning that new skill. So first of all, the learning of that paper is that we need to embrace those errors, and we actually need to pursue errors. And we need to pursue them to make our brains more plastic, in other words, to learn. And that is why we start with a low risk size and or demo account. We want to make errors. We want to see what works and what doesn't work. And then as we make our brains more plastic, as the connections reorganize, as you continue to learn, you will scale up your business. Now, the problem in all of that, and this is really the jinx in the salmon, is that if I, for example, have a mentoring student, there's going to be the theory part and the practical part. And mastering the theory is quite simple, because mastering the theory, I can have a level of difficulty where, depending on who I sit in front of, it always seems not too hard, but also not too easy. So I always choose to walk in a stair-stepping scenario where I only introduce certain topics at a certain time before the previous information is digested and learned. And we introduce that on purpose as we do mentoring, because that is how you learn, right? Because if it's too difficult, then you will completely just say, your brain will shut off, frustrated, oh, it's too hard. But that's the theory. If you're for example, on a self-learning journey, then you need to understand that you want to walk up the stairs. You don't want to jump up the entire level, or you don't want to go into the elevator and go to level 10 and then get out and think you're there, right? You always want to walk up the stairs. Don't make it too hard and don't make it too easy. Now, what does it mean? Don't make it too hard, don't make it too easy. It turns out that actually there's scientific proof on where the sweet spot of training is. So this is a paper that was published here on Nature Communications. It's been peer reviewed as well. It's a solid paper, and here you can see the author. So you can also get the link if you want, and also read through it yourself. So I'm just going to read out a few paragraphs here because these are the most interesting ones. Researchers and educators have long wrestled with the question of how to best teach their clients. That is me, right? I'm trying to figure out, why are some people doing extremely well? Why are some people failing? What can I do to make more people more successful? And so in many situations, we find that there's a sweet spot in which training is neither too easy nor too hard. And so there's all this paper with all these graphs, and they make all these tests. And so eventually they conclude that the rate of learning is maximized when the difficulty of training is adjusted to keep the training accuracy at around 85%. What does that mean? Well, it means that theoretically, you should get things right about 85% of the time, and you should get things wrong about 15% of the time. And so what the literature says is that if you are failing about 50% of the time, the task is probably too hard or too difficult. And so that is not a problem as we go introduce the theory, because within the theory, We can do the stair stepping, and I can introduce the topic so it's not too hard and not too easy. 80 to 85% rule, so that you are getting about 85% right. If you're on a self-learning path, then you may want to choose that as well. You want to master one module before you move on to the next module, so you don't have a high failure rate when it comes to the theory part. But when we get to the experience part, the actual milestone planning, the actual trading, that is now a big problem, because we cannot get an 85% success rate to maximize our learning. It's just impossible. We would be JP Morgan Chase. And in the beginning, you also work with potentially an imperfect strategy, because it's not yet fully, you don't fully understand it yet. So on top of the normal losers, which I don't even like that word, but just the cost of doing business, right? The losers that you need to eventually also have a winner. On top of the normal losers, the losing trade where everything that you did it correctly, you followed the set of rules, and it just ended up to be a loser. The timing was slightly off, or whatever the case may be, right? It just happens. Every second time we're wrong. And so on top of that, in the beginning, you also are doing mistakes. You're trying things that may not work. You're becoming overconfident. You're becoming fearful. You're not taking the right, you're not taking the right decisions. And what happens is that your win-loss is a lot worse than even a 50-50 or 40-60. And what that means is, neuroscientifically speaking, is that, and not just neuroscientifically speaking, but also in terms of our experience from what we've learned all our lives, is our brain will tell us that this task is too difficult for us. And with that, we get frustrated and we will stop. And we will stop because our brain wants to protect us from making bad decisions and potentially going through a path of financial ruin and everything that may come with that, right? And so that is a very, very interesting paper here. And so here also, right, in psychology and cognitive science, the 85% rule accords with the informational institution of many experimentalists, that participant engagement is often maximized when tasks are neither too easy nor too hard. Participant engagement. When am I seeing people becoming more active? I'm seeing people becoming more active when things go well, when we have a winning streak, when about 80% of the time we get things right. That's when we have most people active. So their study that they did, I can completely just copy paste into the campus. I see completely the same results. Now, I'm introducing this study to you. You don't have to read all of that, because you need to be aware of the mechanics. If you're aware of the mechanics, you can start to rewire your brain, right? And so indeed, it is notable that staircasing procedures that aim to iterate task difficulty so that error rate is fixed during learning. So about 80 to 85% accuracy. Also, quite interesting, when given a free choice about the difficulty of tasks they can perform, participants will spontaneously choose tasks of intermediate difficulty levels as they learn. And so we want to choose something that's not too hard and not too difficult, right? And if it's too difficult, if it's way below that accuracy rate, we just automatically deem it, or our brain deems it as too difficult. And what you will get is exactly that. We have a winning streak, participants, there will be more participants in the room, people will get interested, they join the game, we catch a losing streak, they're like, this stuff is too difficult, it's not for me. Fear, you want to protect yourself, your brain wants to protect yourself from financial ruin, and you get out of the game. And what happens is you're not consistent in the game. What you need to do through the milestone planning, one of the most important processes that you need to undergo, that I have undergone many times, is understanding that I can come back from a losing streak with a winning streak. And so we first need to be able to lose to be winners in this game. It sounds so cheesy, but it is like that. And that's why I always say it's an imperfect game. If you're looking for a perfect game, if you think you're all, it's going to be like math, I'm going to win one, I'm going to lose one, I'm going to win one, I'm going to lose one, I'm going to win one, I'm going to lose one. And every second trade, I'm always having a 1-2, I'm always having a 1-2, and it's always going to be like that. There's always going to be 2 hours at the end of the month. Then it's not a game for you. But it may be a game for you if you understand that all of the stuff that we've just talked about, right? So we always have to remind ourselves that this is not a perfect game. It consists of winning streaks and losing streaks. And the only way how we can overcome this is to be a consistent participant in the game without having heightened levels of intensity, because heightened levels of intensity will mean eventually we will fall down the cliff. So now I'm having a few comments here. Camilo is asking, what would you consider a winning streak in terms of consecutive trades and time frame? A winning streak can look like many different things, right? It can look like many different things. If you, for example, look at what you're also going to see, Tanu's trade log, what we are going to share, which basically some of those trades copy and paste, not just copy and paste, but execute a slightly different, with a slight difference. Our trades in the past 3 months, our trades in the past 4 months, and I know Bernd's trades have been in the agriculture markets, have been spot on, extremely successful as well. So have mine. So my success rate in the last 3 to 4 months is between 80 and 90%. I almost have no losers in the trades that I call. And you can look at all the DMOs and back test this yourself. And this is a winning streak because months in a row, I have no losers. And the winners that I have, some of them are conservative winners, some of them are 1-2s, 1-3s, 1-1s, but a lot of them also are big winners. And so what I understand from looking at my past months is that I am right here. But this is also not reality. Even though I wish this to be reality every time this happens, I know though that this is not. Right? And so what you need to understand is that eventually there'll be a losing streak that will potentially average this stuff out. And everybody needs to leverage on the winning streaks. And that's why you quickly want to scale up your business. And when things go well, you want to scale down your business. Because as things go well, few trades in a row, potentially it means we may catch a losing streak. So you want to also take a step back and say, oh, this is a losing streak. Okay, let's battle through that, but let's protect as much capital as we have. And then as we gain momentum, confidence, winning streak, then we again, we can look to scale up rather quickly. Whatever that looks like, 5 trades, 10 trades, there's no right or wrong. I think 5 trades may also be fine. But for the average, it may be 10 trades, especially, as you're testing some things out. Does that make sense, Camilo? On the other side, a losing streak may also mean that 2 months in a row, I'm making negative Rs at the end of the months, right? So let's losing and winning streaks. If we speak about months, then of course, now I'm talking about our goal, right, of 2 hours per month. Then of course, you're going to say, yes, of course, 2 hours per month is all I need to achieve. This again is the binary, the perfect world, right? What's going to happen is not that. And by the way, I know some people that have, double-digit Rs already in the first 2 months. And so if you have double-digit Rs already, you're at a very comfortable place. You can scale up your business already. So if you're overperforming your hours as well, it's maybe a KPI that you can just move on. But this may look like in the first month you have 5, in the second month you have 1, in the third month you may have -2, you may have -1, you may have 0, then you may have 5, right? And so this could be whatever, and then you could even have 1 month where you may have a -4, and then you have maybe another month where you may have a -3, and then again you may end the year with a 2. Now at the end you only have a sum of a 6, right? You only have a sum of a 6 here. And so this is not representative of what should happen at the end of the year, but in terms of the swings and numbers is something that you will see, right? So it's not like the salaries that you're used to the corporate world, where every month you get exactly the same, you get 2 hours at the end of every month, right? You get your paycheck. It's going to be some months you make more, some months you make less, and some months you have to actually make no money. You have, you have more costs to hold your business than actually revenue comes into your business. And why is that the case? That is the case because you are running a business, and just like every business, you're going to have different numbers at the end of the month, right? It's not every month going to be the same, but also like every business, most businesses are seasonal, right? Automotive, for example, during Ramadan, lovely time, lots of deals, lots of cars to be sold. For us, the best time of the year are exactly these months: October, November, December, January, February, March. If you want to be successful as a trader, you have to be consistently active in these times, because these times is when the best seasonal periods overlay. You have October, November, stock rallies. In terms of seasonality, you have the gold and silver and precious metal rally setting up. And then in February, most of the time, you again have equity indices setting up. Then you have other great trades usually that work out, like it's already been talked about in the news feed, whether that's happening this year, like sugar, right? And then usually markets are very slow mid-year, summer. That is also normal, because during summer, also Wall Street goes on holidays. And when Wall Street goes on holidays, there's no one driving the market, and things become a little messy. And also for us, that doesn't mean we should stop trading here, because again, we need to be consistent. We need to be active all the time. Our mind needs to be in the trading game all the time. I cannot expect to be inactive for 4 months and then take the right decisions as things go back to now it's the main period for us, right? So we need to be active. We need to be in the game all the time to catch those winning streaks and take the right decisions when they happen. So if I could have a time cursor here, then we would start in probably October here, right? And then we would go to the summer. This is just on average what I experience over years. This may be very different for you, but this is just for me what I experience over years. We go into the summer, we may catch a very low, not so much happening, not so many trade setups that set up nicely. We may talk ourselves into certain trades. There may be a losing streak. We may take wrong decisions because we were bored or whatever. And then we lose interest, right? And as we get back into September, and we hit the winning streak in September and October, in January, February, you should have seen how many people that I haven't heard from in a while now all of a sudden. And I'm not pointing at anyone out here, right? And also in the beginning, by the way, when I talk, I'm not trying to point anyone out here. but I'm seeing a lot of people becoming active again, a little too late. But I want you to understand that, and I'm also not pointing fingers, and I'm also not saying you are wrong or this is well, how can you, right? What I'm saying is this is normal. This is absolutely normal. You're not the only person who's doing that. If you find yourself in those shoes, it's absolutely normal. It's actually not just neuroscientifically proven with the reconnections of the nervous system in our brain, and the neuroplasticity and all of that. It's not just proven, but it's what we have learned. We're wired that way in all of our experience. So it's normal. And so we have to rewire that in understanding the mechanics and choose consistency over intensity, and understand this game is made of winning and losing streaks. Just a little longer here. I'm about to end the session. There's a couple more comments. Siwar saying, wow, love this. I have been doing this for a really long time, and now I have an explanation for my track record. Yeah, so Siwar, I love your honesty here as well. I also know you've been many times on and off and on and off. And so if you find yourself doing that, the worst case is if you're counter-cyclical to what we're doing, right? You're on when we have a losing streak, and you're off when we have a winning streak. If you're following our trades, the only way you can learn is to be cyclical to us. That means you have to be consistently in the game. The best traders that I know, though, are the ones that have created their own cycles, their own periods, their own seasonal periods where they do well, their own seasonal winning streaks, their own seasonal losing streaks. People like Julian, people like Toby, that don't even know what I'm doing. Why are they doing so well? Because they have proven themselves. They're not copying anyone. They're not following anyone's calendar or anyone's routine or anyone's cycle, winning and losing cycle. They have their own, and they have proven themselves that they can come back from a losing streak, right? And so that needs to be your ultimate goal, is not to be in any one of those milestones. Your ultimate goal, it needs to be there, not watching a single of my sessions. That needs to be the goal. And whether you make $400 at the end, not watching a single session, or $700 at the end, that needs to be the goal. Because if you can do that, usually your own decisions, if you can be at a place where your own decisions overrule what anybody else says, that is the most powerful in the world of trading, right? And also when you see that I'm taking charge of a few markets, Bernd is taking charge of a few markets, and Toby is taking charge of a few markets, it's because each of us, we have our own cycles. We have our own opinions about the markets, and our trade plan in terms of the set of rules are slightly different in the way how we act and when we act. And so we will take different trades at times. And the worst thing for somebody who doesn't have a cycle yet is following different cycles. And so if we only cover our own markets, then you will only just cover what Bernd's cycle is for agricultures, what my cycle is for my markets, and what Toby's cycle is for Toby's markets. And whether they take good or bad decisions, you follow them consistently. Because I never know if my decision is the right one, or if Bernd's decision is the right one. Beforehand, I don't know. Neither do you. But I know that consistently I can make the right decisions. I've proven that to myself, right? And so you need to prove that to yourself eventually as well. How that looks like, it is going to be done within your trade log as well, where you have to track what's your own trade, what's a copy trade. How do the copy trades perform versus your own trades? What you will find in the beginning is that, of course, our trades are doing a lot better than your trades. That's just how it is, right? But that's why you copy. But eventually you need to get to a point maybe not as good as Julian is, but where Julian is, where your own trades outperform our trades, right? This is very much possible because I always just take the most conservative trades. So with that, I want to finish with the over leveraged trades. And then we're gonna call it a day. So stay tuned just for a little bit longer. And this was a long session because all of this is interconnected. So over leverage. An over leveraged trade is a trade where your risk parameter, your usual risk parameter, is higher. And it can be as high as 2 to 3 times higher, depending on how many trades within that asset you would then take. And so what I mean by that is that during certain times of the year, you're going to be allowed to take a higher risk size. So these kinds of, I call them over leveraged trades, they're designed to do the following. They're designed to give you the chance to get a head start into the new calendar year and to finish the calendar year on a strong note. And those are the strongest trades that I've chosen here, what I'm listing, just the strongest trades that I personally have in a decade of trading, close to a decade of trading. Every single year, these are averaged up the strongest trades. And so they include equity indices, October, November buy point, and precious metals, December, January buy point. And so there, towards the end and towards the beginning of the year, on those trades, if you decide to take them, you are allowed to over leverage usually. And also in the beginning, that's important because what you're trying to do is also trying to get used to a higher risk size. And as you over leverage, that's almost like increasing risk size. And so you get used to a higher risk size and you potentially are choosing the right trades to do that. Okay, so these are also good trades to choose as you scale up your business. And number 3, on all the trades where you have a COT long-term extreme plus a seasonal pattern plus the higher time frame in terms of supply and demand, if you have these 3 aligned, then you can over leverage your trade. That may look like precious metals. You're trading palladium, gold, and silver, 3 trades, all within the same asset group, precious metals, that are all kind of positively correlated. They move the same, but you all trade them with 1 risk size. And so you have 3 risk size 3 on the table for the same kind of trade idea, which is precious metals, December, January. But clearly you're over leveraged because all these are highly positively correlated trades, which we usually would see as separate trades. These would come under risk limitations, but more to that next time. So what we have to understand is, of course, our expectation that these trades are also not guaranteed to be winners all the time. However, they do have the best track record overall. So for example, last July, I remember usually in July also we see gold and silver usually rallying. We have had a strong seasonality and a strong short-term COT as well. But the markets based a little bit, gold rallied just a little bit, and then they just fell through the floor. And that happens too, right? So these are nowhere close to being on 100% success rate. 100% success rate doesn't exist, but these are the most consistent trades that I have. And so these are also the trades where I usually over leverage myself slightly on too. And so you can also see in terms of timing, and as you look at this, right, these usually happen here, right? 4 or 5 months consolidated where we have a lot of strong trades and things are going very well. And September, by the way, is also in terms of seasonality speaking, for most agricultures, they go up big time. And so there's just a lot of strong seasonal patterns during that time. That's the only way how I can explain why the end of the year, the beginning of the year is always stronger than the mid of the year. but it could be very different for you personally eventually, right? Again, this is just my cycle that I'm speaking about. And so the most important with that is, as you're copying my cycle of trades or burn cycle of trades, that you're consistent with the copying and that you're not on and off. That is the main part of the lesson. And that if you feel today that I've touched a nerve, or you feel like, hey, I really find myself about here, right here in the same shoes, then also understand that I don't want to point at you and say you're doing everything wrong. Quite contrary, I want to point something out that I am seeing a lot. And because I'm seeing it a lot, I obviously want to make sense of why certain things happen. And these things, we can make perfect sense of them by looking at the neuroscience and at our psychology and the way how we are just wired as humans. And as always with trading, what we have to do, we have to rewire our brains to think slightly differently than everyone else. So I want to end the session here. I've gone a little bit over time. Next time we're going to finish money management, the kingdom to wealth, and we're going to move to the next topic, which is then retirement planning. So CBAR, you start scaling up in September. Is CBAR saying we start scaling up in September? No. No and yes. In September, you can always look to scale up if you're doing well beforehand or just as a separate trade. But if you have been doing well in the past 10 trades on average, if you hit those KPIs, then you scale up regardless of the months, right? You just scale up your business and you move on to the next trade. But for sure, September, for sure, if you are by then still following my cycle, then understand you want to be active within the end of the year, for sure, if you at some point become inactive because of other commitments. Any other questions, comments? Thank you, guys. All right, guys. Thanks for watching, everyone. I'll catch you all next week, and ciao.